Good evening. Welcome to Money Matters. I'm Charlie Shields, Wells Fargo Advisors, LLC. My co-host tonight, Pat Welde, Merrill Lynch.
Charlie,
Pat,
how
good
are
to
you?
see you. I'm doing great.
You.
This is going to be a terrific show tonight. We've got my favorite guest, who's on fairly frequently, Mark Mulholland, Matthew 25 Fund. And Mark's got a great track record. Market's been treating us well lately, and I think it's going to be a great show. Stick with us. Okay, let's kick it off. I've read some places where they're talking that if you average 10 years of earnings, that we're at a 25 PE and this sort of thing. Looks to me like the price earnings that we should be looking at is quite a bit lower than that.
Right.
The market's had a pretty good run as we tape this show. I want to remind our viewers and listeners that it is taped, so don't make any market timing decisions based on what they hear here. But how does it look to you after a big run in the previous year? What do you think? Are there still some places you can find values?
Absolutely. I'm still very optimistic, especially relative to what else you can invest in. But I think viewers and people need to be very realistic and stop listening to the market is at new highs, therefore it's expensive. That's nonsense.
Good.
The market's at new highs. I'll give you that. That's a fact.
Yeah.
But it's not expensive. Expensive is measurable. And the market, and I'm also going to tell you, forget about that 10-year average stuff. Whoever invented that, that's silly, quite frankly.
Yeah.
I mean, a lot of things happened in '08 when the end of the world was occurring. That was once in a lifetime. You can't use those normalized earnings. That's silly. PE analysis is real simple. The S&P is where it is. Divide by, you can use whatever estimate you want for earnings. Let's start with maybe $105. The PE is about 17. That's not expensive. So yeah, I think there still are values in the marketplace.
Okay.
Lots of them.
Mark, how do you see it?
Well, that expert is the guy Schiller from Yale University, who was bearish in '08, bearish in '09, telling us like earnings were, at that time they were like outperforming historical norms based on return on capital and stuff like that. I mean, he's probably a really nice guy. I'm sure his family loves him, but you won't make any money following him. So just don't worry about him. Pat made a really good point. The market's at 17 times trailing earnings, 15 times expected earnings. It's completely where it should be. We're in a normal scenario. The normal rate of return from the market's average 15 to 17 PE gives you a 10 to 11% return going long term. We're right there. It's not as great a buy as it was 5 years ago, but that's obvious.
And one of the drivers for what price earnings ratio you should pay is inflation. So do you see inflation coming anytime soon?
I personally don't. I mean, I'm sure at some point we'll talk about the drivers of inflation and we'll get your opinions, but no, I don't see it. I mean, the reality is this, the global economy is far too competitive, and I mean, pricing is not rising just because it has to rise. I mean, there's always someone out there looking to, do whatever you're going to do for less than you're going to do it. And that, I think, is putting a lid on inflation and will remain so.
Mark, how do you feel
Well,
about it?
I agree with Pat. I come to it from a different way, though, because I'm much more a monetarist, and it's really money in the system on productivity. And there was like a big risk when Bernanke was putting liquidity in the system, the economy wasn't growing tremendously, like if it be inflationary. It never showed up. And if you look at the numbers now, I have done this on this program. I look at this probably at least once a month. I take the spread between Treasury notes and TIPS on the matching maturity, and I think that's the best measure of what the market's telling you what inflation will be. And I did these. I know we're not supposed to tell when we did it, but 5 years at 2.17, 10 years 2.15, 20 years at 2.31. That's what the market is telling you what inflation will be. About as benign as you can get. 2% is what their goal is. So,
Well, you'll have these extraordinary situations, 2008, back in 1974 when Nixon was getting impeached. You'll have 8 PEs. But generally, over the long haul, a rule of thumb that seems pretty good is 20 minus the inflation rate is the PE you should expect. So if we think we're going to have 2 or 3% inflation, a 17 PE is not out of sight. And quite often the market will overshoot a little bit on the way up and overshoot on the way down, right? So
yeah, what's great? If not taking the data from anyone who has an axe to grind, from Standard & Poor's, S&P, who does their data from bottoms up, looking at their companies, they are estimating earnings this year being about 121 on the S&P. And if that's the case, this market has about 12 to 13% upside and still be normal, like what you were just, based on the measure of 20 less inflation and historical norms. So No, it's good. We're fourth to fifth inning, I believe, in the stock market right now.
So if we watch inflation, we may have a 15 to a 20 PE that will trade back and forth until inflation starts to cause a problem.
Yeah.
Okay, so let's talk about long-term bonds for a second. I know you're more interested in the stock market, Mark, but Pat, what's your opinion? Do you still think long-term bonds are dangerous?
Absolutely. I think the perception that most investors have, people need to come to grips with this. Bonds are not safe. And I think the perception is bonds are safe because they've been safe for 50 years. And for 50 years, I'll remind people, interest rates have been declining. For most of our viewers' lifetimes, rates have been declining.
Yeah.
Note to self, that game is over as of March of this year. In March, rates hit a lifetime low. And I'll say that to an 85-year-old, and I'll say that to a 2-year-old. They'll never see rates as low as they were just 5-6 months ago.
So you would say to a person that missed the 3 5/8 mortgage and says, "Oh, I've missed it. It's 4.5." Go on in, right? Because
Absolutely.
rates are still low historically.
Without question, and they're still really, really cheap. Are they going to go a little bit higher? They will, and that'll be difficult for bond investors to get an acceptable return. So yes, I'm still not a buyer of anything long and not even intermediate term in the bond market.
Now, suppose rates went higher. Let's talk, say the 30-year bond went up to 5.
Sure.
Would you be a buyer up there?
I think at that point, then people need to step back and talk about what you and I have talked about on several of our shows, recognizing truly what they're trying to accomplish. What is your required rate of return to live the way you want to live, the way you've dreamed of living for the rest of your life without running out of money? And if the number is, 6% or 5%, and I can get that 5% in a long-term bond, which we can today, yeah, I think some of your money, you may want to lock that in and reduce the risk.
Sure. Let's suppose in a year, price-to-earnings ratios have gone up to 18 or something like
Sure.
that. Where you flip that over, that means the return is something 5.6% or 6% or whatever.
Yeah.
And if the long bond is at 5, now, since you have to compensate for the volatility of stocks, that might be a pretty good competition. But for the last 3 or 4 years, it's been no competition. Stocks have been the right place to be, right, Mark?
Yeah, but I agree with Pat. But the one thing you can still argue for, in fact, for myself in the last 12 months, I bought some bonds, but municipal bonds where you get 5%. Thank you, Uncle Sam. It works out to be like a little bit over an 8% return, and that was money to provide income.
And isn't it strange that you get a long-term tax-free bond with about a 1% higher yield than you can get on a U.S. government bond?
It's crazy, and the historical average is 80 to 85% of the yield of treasuries. Now, there's a couple things that affect that. We had that fear factor of the market. We had a breakdown in the municipal bond insurance, but municipal bond insurance is solid. I mean, it's I don't care if you're even A-rated. That's better than most people's life insurance. It doesn't make it easier to sell bonds, but you have a third-party guarantor on it, and it works. Now, on the other side, from the pure general speaking of the bond market, we had a 30-year bull market in bonds. We're past the 9th inning, and that was the end of the 9th inning was March.
Right.
It's going to, I don't know how long it'll last, but we're just beginning the bear market on bonds. In other words, from a price standpoint, they're going to be more risk than reward. But for people who need income, like I told you, you buy municipals right now. I don't know if I would do treasuries, but at 5, I would think if inflation's still 2.2, that's a pretty good deal. So we'll see how it plays. But that game's done. You buy bonds only for income,
Okay.
provide a need.
Well, speaking of what the yields are going to be and what inflation's going to be, let's talk a little bit about what influence Janet Yellen will have. New chairman of the Fed. Everyone says she's dovish. Does that make you concerned that inflation might come back down the road if she's not willing to raise the short-term rates when she needs to?
Yeah, I don't. I have a little difficulty with all the. Everybody knows exactly what Janet's going to do because of what she did when she was a member of the. Well, now she's the queen. I mean, she's in charge now. So I'm not so convinced that it's going to be as easy as people think it is. And again, I think our job is to basically see what actually happens and react to it and manage people's portfolios in light of what's really occurring.
Good answer. What do you see? You see some risk of inflation?
No,
down the road?
No, because remember I told you I'm a monetarist. I'm one of these guys. But every time it drives me nuts when I hear someone in the media and they'll sit there and they'll say, inflation's coming because the economy's heating up. It's going to. That's what they call demand side. I'm a supply side. I mean, they've been very liquid. It hasn't caused it during a fairly weak economy. I think this economy is going to get stronger and stronger. So they'd have to make serious mistakes of over liquefying what the GDP is going to be giving us.
So even if she leaves rates at 0, when long bonds are at 5 and the economy's booming, everything will still be fine.
It could be. That's overdoing it. That's exactly. Because
that's
right now,
my point.
Yeah, but there's no way she'll do it. I can tell you, they look at the tip spread more than I do.
Okay.
And it's pretty cut and dry. It's the best market to tell you.
And if it's September of 2016 presidential election year and she needs to raise rates, she'll do it. She doesn't care about what happens in the election.
Well, here's the thing I'll say about that. On a scale of 1 to 10, Greenspan is going to go down in history as the worst Federal Reserve chairman we've ever had.
Okay.
So he's a 1.
Yeah.
Bernanke, I think, is the best we've ever had. If we end up somewhere down the middle, we'll be okay. If we survive the worst and we get the benefit of the best, we'll be okay.
Fair enough. All right. I just wanted to test you a little bit on that one. All right. So let's talk about the outlook for real estate. I know you bought a house about a year ago. What do you think about real estate?
Well, I actually bought it 3 years ago.
3 years ago.
But that's why I wanted to see where you are on this. I think we're in the first or second inning of real estate. And even though, majority of my net worth is in the market because it's in the fund, but I just spent last weekend looking at some other properties down the shore. I think this is a great time to buy real estate. I think we're, 3 years, there's been a little bit of a gain since then, but that's like buying in the stock market at March of 2009. I feel like we're right now at November of 2009. Like there's a lot more to come. You're over the worst, the fear thing, remember all the articles about failure, defaults and stuff like that? Nobody's doing that. Banks have been writing up their defaulted mortgage portfolios because they're back into black. No, it's the best asset the next 5 years, I think, will be real estate.
Pat, you have an opinion on real estate?
Yeah, I do. I'm less optimistic than Mark. I'm not saying it's not a good time to buy real estate. I think it is, but my reasoning's different. I think it's a good time to buy real estate because financing alternatives are fantastic, as we talked about. You can buy a lot of property with a smaller payment because rates are so low. The financing costs are low. I'm not optimistic that piece of real estate is going to appreciate. I'm just not. And the reason is, I think things are very cyclical. And real estate had an enormous, abnormally good run up through about 5 years ago.
Yeah.
And it's not about to turn this quickly, in my opinion. I just don't see it. I think it's, I think real estate prices will be where they are now 5 years from now.
Well, like Mark, I put my money where my mouth was. I sold in 2005, and I bought back in. We got a beautiful home in the burbs in 2011, late 2011. And my attitude is we're enjoying a beautiful home.
Sure.
We got a good price on it. We got a 3 5/8 mortgage rate. And I'm going to sit back and enjoy that home, and I hope Mark's right, but if he's not, and I have to wait 8 or 10 years before I see the value up there, the main thing you want to do with a house is buy it to enjoy it. If you can get it at a great price, then that's fine. Well, let's try to help one of our viewers. Roger Lehman of Pottstown says, what stock sectors look bright for the long-term investment at this time?
I'm very optimistic about pieces of healthcare. Healthcare is a big area. There's lots of parts to healthcare, but I think my premise is rock solid in that just look around. People are living longer, a lot longer, and a lot longer healthy. And the reason they're more healthy is because of all these different drugs and treatment facilities and all the areas of healthcare. The most optimistic piece, the piece that I'm most optimistic about is biotechnology. Biotechnology, now viewers have to be careful. This is a very volatile area for individual stocks within the group. There are some funds that participate in that group and some ETFs in the group. But these large pharmaceutical companies are flush with cash, generating hordes of cash. And many of them have very thin pipelines of new next billion-dollar drugs. And I think they're going to be buying pipelines, which is what the biotech companies have.
All right, and let me mention one other sector, and then I know we want to really explore it with Matt. the banking sector looks interesting to me because the long-term rates are going up and the short-term rates are staying low, and that's going to improve their balance sheets. I am, of course, not allowed to have an opinion on Wells Fargo, but I think there's other banks to consider, and I believe that that's going to last for at least a couple of years. So, and I think some banks will be restoring their dividends, so I'd be shopping in that sector also. Before I ask you, Mark, I just want to put up our email and our address in case you want to send in a question. If you have a question, send it in to Money Matters, 205 East Levering Mill Road, Bala Cynwyd, Pennsylvania, 19084, or send it to moneymatterstv@gmail.com. Okay, I wanted to give you plenty of time to get into this because this is your rice bowl here, talking about sectors of the market and what you like and what you don't like.
Well, I'm not a great top-down person, but I can tell you from what I own working up, our largest holding, and it's been for a while, is Apple, but they're not the only tech stock. I mean, I think they're a fantastic company. It's still cheap. The tough play on technology, there will be some companies that are on the wrong side of the technology change. That would be like Intel, Microsoft, but they're cheap. You know, people can do them. They're a little bit more, in my mind, a flip of a coin. I'm not quite sure. I don't disagree with you on the pharmaceuticals. They're cheap, and they might get growth, but we don't know where they, you know.
Now, you said pharmaceuticals. You mean biotechs particularly,
no,
or are you talking
actually,
about
there I was
big
just
pharma?
addressing. I know they're cheap. What really appeals to me next, I'm going to do it based on our holdings. Our second biggest holding is Brandywine Realty, which is a commercial real estate trust. Like a lot of times, people always think like earlier, like, you know, real estate's outside your home, you know, buy apartment, and stocks are here. Well, one of the largest owners of real estate, both public, you know, or public companies like some of the land holdings, like St. Joe's. I can't even think of a company out of Hawaii, but there's plenty of ways to play it. I happen to have Brandywine because I think commercial real estate is really, really quite cheap. You can buy it below replacement cost, deeply below replacement cost, which is a good sign. As a pool, our largest holding is financials right now. And the only reason it's done that way, there's a rule with a mutual fund. So one handicap on a mutual fund, it goes back into the 1920s that you can't, or 1930s. You can't really buy more than 5% of a company gets more than 15% of their business from securities. But there is no question in my mind that, you know, Goldman is outstanding buy. J.P. Morgan Chase is a great buy. A little more speculative, Bank of America, because you're going to get Merrill Lynch as a freebie ultimately and stuff like that. I think the odds of making money on the financials, because they really have underperformed the last 3 years, and a lot of it's partly because what's been going on with them, you know, from the federal level, just a tax and regulation. But financial businesses are just money, and, you know, it's basically people and money. It's the most flexible assets you can have, and they're going to adjust and make a ton of money over the next several years. I mean, Goldman top guys have been taking all their bonuses in stock for the last 3 years and restricted for 5 years sales. So they were taking a long-term approach on it. So I agree with you on that. The financials are fantastic. They're cheap. You can still buy these great companies close to book value. And book value is going to grow at least by 7 to 10% over the next 5 years. So.
Well, let's remind our viewers and listeners that we don't give them accounting advice. We're not lawyers. And if they're going to believe what we're telling them, I want them to verify it with their own financial advisor before they make a commitment.
Yeah.
Anything to add, Pat, to that question?
No, none at all. I think your caveat's good. Other than financials, what other areas of the marketplace are you finding value?
Well, I think materials may start getting interesting if the economy is going to recover, and maybe people just buy an index there, something like that. I mean, the way I feel, some sectors you can try to get in there and figure out Apple's better than Microsoft or something like that. But in the materials, I think it's going to be okay just to go ahead and buy the index, and I think that'll do pretty well. But the usual caveats: check with your financial advisor. And don't
Charlie,
try to time.
How are you on commodities? You study that more than I do.
Well, commodities, I believe that commodities have a place for people that are afraid inflation might come back. An insurance policy. I didn't want people buying gold when it was up at 1,900. It's come down to the 1,200 area right now. So I am willing to go along with somebody that says I'd like to have a 2% or a 4% holding in commodities in order to protect the rest of my portfolio. And I tell them, if you make a lot of money in this commodity holding, you're going to get hit in a lot of the other stuff. So, you know, that's up to the individual. As far as, I don't think you should just run in and buy gold. I think if you're going to buy commodity, you should try to use a mutual fund or something like that. And I was just looking the other day, there are some mutual fund managers that have a good track record that are, and their mutual fund is within 1% of the low. So if I was going to do, for the last 12 months and for the last couple of years, so if I was going to buy commodities, I'd probably do it through some expert that knows what they're doing. How do you feel, Pat?
Yeah, I have never been really a commodity or a gold bug. Again, some clients, have that fear factor, and if, I tell them, I stole a line from you, Charlie, and I tell people if they want to own this gold, we can put it in the appropriate percentage, but let's hope we don't make any money on it.
Yeah.
Because if you make money in that, the other bigger pieces of your portfolio aren't going to perform very well.
Good. One interesting aspect in commodities is natural gas. Now, I find that's kind of interesting, and I heard a really wonderful comment the other day that natural gas really may help the United States of America, but it may not help the investors that are in natural gas. You want to talk about that, Mark?
Yeah, I don't want to bore you because we had talked a little bit about this, but I happen to think there's so much economic potential for the country for natural gas and oil is outstanding. I mean, we could literally be at a trade surplus if they can eliminate the imports of oil, and, not gas, but oil. But but it could be neutral to the actual companies in there. But it's still, the potential's so strong. I bought some natural gas, oil plays within the fund, but I spread it out because it's hard to really figure out who has the advantage. But along those lines, all these great booms, like the gold booms. You've heard the little anecdote that it's the general store owner who makes money, not the miners and stuff like this. So along those lines, one of my 3 stocks that are in that natural gas play is Halliburton. Okay. Which that's why I figure, in theory, on value, if it works out, the drillers will make the most money. But I'm pretty confident that drilling is going to expand in the next 10 years in this country. And I think Halliburton, and there's others, Baker Hughes, Schlumberger, they can all make money. Just, I happen to like Halliburton better. But it's so it'll come. But you're right. It could be like the airline industry that's been wonderful for the economy, but never really made money on the airline stocks as a whole. And probably even the internet. So remember the internet bubble? No question, it turned out to help the country. But a lot of stocks didn't really work out so great,
Okay.
The one difference, though, gas companies are cheap. You're not paying really a premium for them. That's part of the reason why I got it.
That's true, but maybe they're cheap because the price is so low of natural gas, and what if it stays low? So part of the question we have to figure out is, are natural gas prices going to rise so their earnings can increase?
Well, I wasn't doing it on earnings. I was being cheap on
cash flow.
Look at proven reserves.
Okay.
One of our holdings, Devon Energy, has almost $3 billion in proven reserves, mostly oil. And if you value the stock, it's only valuing that oil about $10 to $12 a barrel. That's what that gives, and they just made an acquisition, which is they paid 2.5 times cash flow, but didn't give the proven reserve numbers yet. But it's cheap because everyone has a little bit of hesitation on it and stuff like that. So it may not work out, but it was one of the things that it's like your commodities. Like I would kick myself if I didn't put something in it and it worked its way. So.
Okay. How do you feel about the natural gas play? Are you putting people in those stocks?
Yeah, I am not. Again, I would prefer in the energy area. I'm a quality guy, so I like to own the big, strong, the Exxon Mobils, the Occidental Petroleums.
I think they're cheap too.
Yeah, and a lot of them are getting into some natural gas.
Most of them sell above their proven reserves, but they're cheap on cash flow. So it's.
Okay, well, what I want to do is take a couple of minutes to explore overseas investing.
Sure.
And then we'll take 2 or 3 minutes to get some more ideas from you, Mark.
Sure.
Pat, I feel like right now, when I look at some of these mutual funds that manage emerging markets, PEs are 10 or 11. So it seems to me this might not be a bad time to move a little money into the emerging markets. How do you feel?
I'm actually moving a lot of money into the developed markets overseas, not so much the emerging markets yet.
Yeah.
I really just think side by side, as I said earlier, our markets are not expensive, but they're certainly more expensive than they were 4 years ago.
Yeah.
I think you're getting an opportunity in some of the developed international markets to get our valuations from 3 years ago today.
Sure.
Example, we're at 17 times earnings here in the United States. The German DAX index is at about 12 times earnings. That's cheaper. Our markets are averaging a yield of about 2.25% on the S&P. The DAX index yielding closer to 4. So I think the developed international markets are a place, whatever people's asset allocation is that they want to have, and talk to your advisor about this, but if it's 20% or 30%, now's the time to have that 20 or 30 max, in my opinion. whereas they may be underweighted internationally because their U.S. stocks have done so well. That part of the pie is broadened out.
And you want to wait a little while because the emerging markets are getting beaten up and China's having their problems and all that. So you're waiting to overweight the emerging markets.
Exactly. Till I see some visible evidence that they're getting better.
All right. Well, with a couple of minutes left, I know a lot of viewers and listeners like to tune in for your ideas. You want to give us a couple more stocks or sectors that you like?
Well, this is a repeat, but when you were just talking about the foreign, one of the things that I like about the domestic U.S. financials, if you look at Canada, their banks. Now, Canada never really went through the kind of market hit we had been hit because they're where I think we're going to be in the next several years. They had a commodity, energy-based economy. It'd be like Texas did well in the early '80s when everyone else was struggling. But every one of their banks sell from 1.5 to 2.5 times book value, and book value is going to grow for the. It's one of the reasons where I come up with a scenario like a Goldman or J.P. Morgan, or PNC, a Pennsylvania bank that's selling pretty close to book value. A book value is going to grow conservatively, especially with buybacks, but just the earnings being retained at least 7 to 10% a year. So that means in 4 years, you're going to be 50% bigger in book value. If it goes to 2 times, 1.5 times, 1.5 to 2 times book value, you get a great multiple, and you get a great bang on your buck. So that appeals to me. Internationally, I'm not great there because I like to read financials, and what they provide is a lot less. But I do have one foreign stock in our fund. It's Telefónica España, and that came from looking the Europe right in the bottom of their crisis. I went through and looked at everything that was and I can get in an ADR, which you get a little better reporting. And that was one I bought, loved, and I still think it's a good buy. I bought some recently.
Okay.
So
Terrific. Well, with a minute or so remaining, we've talked about sectors we like. Are there any sectors you're avoiding, Pat?
Yeah, I think utilities are an area that's going to have an uphill battle. Namely, they always are interest rate sensitive, and with my opinion that interest rates are going to be rising, I think utilities are going to be challenging for investors to make money.
I agree with you. And another thing to think about is on our consumer staples, there was a lot of nervousness for people, and they drove up some of those kind of stocks to 19 and 20 times earnings, and you see some wonderful tech stocks that are selling at 11 or 12 times earnings. So that's a place where I would be looking overseas. I just noticed, for example, if you look at the price earnings of Hershey versus Nestle's, just to make an example, it's two pretty similar companies. Nestle's is quite a bit cheaper. So I'd be careful in that consumer staples area.
unless you go overseas.
Unless you go overseas.
Right.
All right. Well, I think we put together a pretty good show for you tonight. Appreciate you being tuned in. Tune in next week. We're going to have Jules Sessions, Markham LLP, who's a business advisor, and he's an entrepreneur, and he talks about innovation in businesses. It'll be an exciting show. Stick with us. As far as we're concerned, your money matters.